Good day everyone, and welcome back to QuestForAlpha. In my trading strategy, everything comes down to two rules. My rule number one is always trade in an uptrend. My rule number two is that I wait for a pullback into a demand zone, and I only enter after a lower time frame confirmation. Now you can find the full strategy in the description, but you can also refer to the weekly update videos for additional detail. While these two rules have become the cornerstone of my success in trading the markets, I've also learned the following, that one cannot control outcomes. One can only control systems. And in trading, one such system happens to be trade management. So what I would like to do today is I'd like to show you a system that changed everything for me. Most people obsess over entries, but entries don't really make you profitable. Management does. Even though it is the least glamorous or the least talked about aspect of trading. And in this video, I'm going to walk you through exactly how I manage trades using the system from my own trading plan, where I will focus on three things. I will talk about how to set stop loss, how to take profit, and then to adjust your stop. And finally, what I'd like to do is I'd like to go through my November trade summary, what worked, what did not, and how trade management can really make a difference. So with that, let's get into it. When you think about stop loss, most people imagine one fixed number. But in reality, stop losses for me just represent a framework. And choosing the right one depends on many conditions. It can depend on the volatility of the stock, the type of the setup, and probably it'll depend up to you as well. So let's break down three different stop loss styles and three stop loss mentalities I use. The first one is, for example, using the 2-to-1 risk to reward stop, where the stop loss is always placed below the consolidation. So you can see that in this example over here, where this is our consolidation, that's the breakout, and the stop loss happens to be right below it. This is what I generally use to describe some of my trades on this channel. If price has been moving sideways, it has been compressing, it has been building energy, and that consolidation becomes your protective zone. So when I trade like this, I place the stop loss, as I mentioned, right below it, just below the lower edge of the consolidation. Why? Because if price breaks that zone, then I determine that the pattern is invalid. So this happens to be pretty simple, clean, and really mechanical way of setting up the stop losses. The second option is a 5-to-1 risk to reward stop, where the stop loss is below the breakout candle. So in this case, this is our consolidation, that's the breakout candle, the stop loss is right below it. The breakout candle is the one that finally pushes the price action above the consolidation, and it just happens to be my reference. If the price falls back below that candle, then the breakout really has failed. I mean, it's obviously not 100% of the time, but if you do try to follow this approach, then you should probably be strict with your rules and determine that, yes, in most cases, this is going to execute pretty perfectly, like in this example over here. But in some cases, that may not be true, and your price may break down and take out your stop loss right below it. This is a nice one because while the stop loss is pretty tight, it does offer a much greater R multiples. The third example is the 1-to-1 stop, where the stop loss happens to be below a significant low. So if this is our consolidation, we don't put the stop loss here, we actually go below a significant low where it just happens to be here. This is very conservative stop. I rarely use this. This is when the trend structure matters more than the momentum. And the logic is simple. If your higher low, in this case this, breaks, then the trend is in danger. You can definitely assume that this price is actually going to it'll continue to go down. And this could be something that one could use for a very, very long-term investment approach to the market. But it is an option. Now, these are the risk to reward options. There is also looking at the 3 stop loss behaviors. So this is where most traders would fail. The placement matters, but the execution style matters even more. So you could have a strict stop loss where the price touches your stop and you're completely out. No negotiation, no emotions. And this is best for trading mechanically and removing any discretion. Then you have a semi-strict stop loss. This is where a wick doesn't take you out, but really you're looking for a candle to close for the day below your stop loss limit. And if that happens, then you're out. So this gives you a little bit of a breathing room. And finally, which is something that I typically use, is more of a flexible stop loss. So this can happen that the price closes below your stop, but then there is a price action, and the price action either shows signs of recovery or no signs of recovery, and you have to make a determination what you want to do. Do you want to get out or do you want to stay in? It is a little bit of an advanced style, but it is extremely powerful. And this is because you're reading the chart, you're not simply just reacting it. And oftentimes when you place stop loss below a breakout candle or below this consolidation and you act on it mechanically, a lot of times these can be taken out simply because there's a lot of people that place those stop losses below those points. So institutions would know about this and they can easily take you out. So that's why and the market can gap sometimes. So that's why I don't typically use that pretty strict method. So regardless of what you use, I think you will find success in any of this method, granted that you are consistent and granted that you make a decision that you will follow a plan for at least a certain period of time and you will follow it rigorously. Now, let's go to the next slide. This is an approach where you want to determine where your take profit is going to be. So how do you take profit and how do you adjust your stop? These slides give few examples here. The traditional take profit is something that you have fixed. It's a fixed reward target. In this case, for instance, in this plot here is a 2-to-1. So you just wait for the price action to give you 2 rewards as opposed to risking 1%, for example, winning 2 to risk 1%. And once the price gets there, you simply get out. So that's one way of doing it. Then you could also look at a flexible take profit. This is where you may consider taking 50% out once your price reaches your initial take profit. So whether that's a 5-to-1 or 2-to-1, it doesn't really matter. Once it gets to that limit, you take 50% of your gains and you try to move your stop loss to break even. So if the price decides to reverse, you never really lost any money, but you gain 50% of your initial desired take profit goal. The third option is a flexible take profit. So this is for long-term investment. It's when you don't really want to get out of the market immediately or in few months, but you keep it for long periods of time, and you will only close it if you really need the cash, whether that's to cash in a retirement check, or you want to buy a house, you want to buy a car, you want to go somewhere, and etc. And then the fourth option could be another flexible take profit, but this is where it's a little bit more aggressive. Once your price reaches a 1-to-1 risk to reward, as opposed to like 2-to-1 or 5-to-1, then you take 50% profit and you decide to move your stop loss somewhere near break even. I don't typically use this method. I am more of a person that uses either the strict take profit, something that I communicate and I talk about on my channel, and very often number 3, where I just leave the stock moving for very long term. Finally, what I like to share here is what actually happened in November with some of the trades I have covered in the channel. So what was traded are the following tickers. They're all listed here in this column. And what I have is, I've used, for simplicity, I've used strict take profit and strict stop loss in one group. And then I use the strict take profit and semi-strict stop loss. If you forgot what those meant, please go rewind the video and you'll be able to see it. Ultimately, the results are pretty similar to each other. The difference is, though, in the take profit scheme that I decided to use. So I used the 2-to-1, the 5-to-1, and 1-to-1. And you can see how the trades actually performed over here. Some trades actually hit the target, and others are still in play, and some were losers, and you know that's perfectly fine. For this specific month, the 5-to-1 RR ended up being the most profitable. You can see that it was 9.3, so we got, for every percent we risked, we gained 9% back, which is pretty significant return, to be honest. But even if you follow the 2-to-1, which is what I talk about in the channel, then you still ended up profitable. And if you wanted to be super conservative, you would have been profitable as well. So this is just one way of structuring your trades. The best thing is to collect the data, follow one specific method, and then explore what if scenarios. So in our case, we spent most of the time in the weekly updates talking about a 2-to-1 risk to reward. But then for this presentation, for example, I took the opportunity to calculate what it would happen if we decided to use 5-to-1 or 1-to-1. And you can see pretty significant differences had we decided to follow the 5-to-1, for example, method. So that's a full breakdown of the trade management based entirely on how to place a stop loss and how to take profit and adjust your stops once you're in the trade. If you take anything from this video, let it be this: entries are exciting, but exits make you money. A good strategy gets you in, and then great trade management keeps you in when you should stay and gets you out when you should leave. So if you found this helpful, then stick around, because this is the part of trading people rarely teach. But it is a part that actually builds consistency. So thank you for watching. Stay disciplined, stay curious, and I'll see you in the next one. Bye.